Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today's Wednesday. It's August 17th. It's hump day. And finally, the markets are down. Believe it or not, their markets do go both ways. Now, I wanted to show you something interesting. I was actually talking about this to my VIP room. What is the sector for that? Here it is. I wanted to show you something interesting. This is a small cap index that follows non-Canadian and non-U.S. stocks. And there's a huge correlation between U.S. stocks. And notice how it looks like this index has peaked out a few days earlier. And it looks like if you look at the QQQ or if you look at the Russell, they look like they just peaked out yesterday. So it looks like this SCZ is leading a little bit ahead, especially on the small cap front. So it'll be very interesting if it continues doing that. But right now, the small caps in Europe look like they're ready to turn back down. And unfortunately, I believe we're going to see the same fate for the Russell stocks and the QQQ stocks and the S&P stocks. This is just too much too fast. Way too much too fast. So you don't want to be stuck at the 200-day moving average in a downtrend when the RSI is that much. That is not a good move. This is one of the reasons why I've been positioning ourselves to the short side more and increasing positions in volatility and increasing positions in defensive trades and shorting speculative and financial stocks, because I think we're going to turn south. Now, does that mean I think we're going to go all the way to the bottom and make new lows? No. I actually think that this trend here is going to hold pretty good, and I think we're going to come back down, but we're way too much. To give you some idea, and this is the bond market. To give you some idea, this is the bond market. Notice the bond market never went above that 8.6 hump right here. Well, I think we're going to be gyrating, and I think the stock market is going to continue taking the direction from the bond market. Matter of fact, if you look at this SCZ, the small cap, let me just kind of give you a little example here. That would be the hump right here. Or actually, no, this would be the hump right here. I apologize. So to me, it looks like small caps are going to come back, and large caps too, and just kind of start gyrating again. Does that mean making new lows, breaking new lows? I don't think so. I think the earnings and the CPI and the PPI has proven that we're a little better than that. Now, keep your eye today on retail stocks. First of all, we've got retail sales. They're expecting, they had a prior month over month 1%. They had now it's negative, not negative, now it's 0.1. I'd love to see this number on the upper end of the range. Not really concerned about vehicles and gas. That's noise. I want to see this number higher. Would love to see this at 0.5. Love to see this number. If this number dips, remember, retail sales makes up 2/3 of the economy. So if this number is weak, especially in light of what we're seeing with the stock market and the put-to-call ratio starting to actually continue staying up here, this means we can go down quite a bit. And that means the bond market could continue cooling off a little bit, because right now we have more evidence that the Fed can, in fact, raise rates without hurting the economy. So we do have retail sales, but in addition to retail sales, we've got earnings. Now, yesterday we had Walmart and Home Depot. Both beat expectations, but the market did not like Home Depot as much as Walmart. Today we've got Lowe's, ADI, and Target. Now, remember last time how much the retail sold off after Lowe's and Target? That was one of the biggest moves. The news was really bearish, and the market really sold off. So 72 cents is the expectation for Target. It's been beaten down quite a bit. If you look at Target, let me do that for you. You will see that this is last time. And I don't think this is going to sustain itself. I think it's going to come right back into its range. I don't think we're ready yet. It's already down about 2.5%. So I think Target and all these retailers are going to go back into the fold. Now, let me just give you the other ones so you have them. So you got Target 72 cents, ADI $2.43. Chips haven't been breaking out either. And Lowe's, well, it's interesting because we don't know if it's going to take the shape of Home Depot or Walmart, and already Target is down. So I would think Lowe's is probably going to follow the, let's see, it's up 6. No, it's doing well. See, this is what I'm saying. You just don't know. And it's above the 200-day moving average, which is really, really positive. So again, we may see something positive from Lowe's. Let's look at ADI. Let's take a little sneak peek here. Yeah, Honestly, in good faith, I think the market's going to revert below the 200-day moving average. Let me talk a little bit about global economy, and then I'll talk a little bit about technicals. Analysts warn major risk remains as surging COVID cases in some countries in Asia. We're talking about Asia right now, along with worries about global inflation and China policies to curb inflation. Folks, if you think we're out of this, we're not. In New Zealand, central bank raised its benchmark rates from 2.5% to 3%. As it continues to battle inflation. In Japan, government data showed a trade deficit in July for the 12th consecutive month. Soaring oil prices and the sliding yen were key factors. And Japan imports all of its oil, and winter's coming. And it gets a little chilly there too. U.S. stocks had their best month in a year and a half in July, and the winning streak has been continuing into August, particularly on hopes that inflation is easing. I'm hoping it will too, but folks, we're not out of danger zone yet. The latest government report on consumer prices showed that inflation essentially stalled from June to July. You know, any evidence, and CPI looks like it could have peaked out, and PPI, any evidence that it's not getting higher is bullish for this market, but there's only so much the bulls can run up to. The latest results from retailers show that spending has been solid, and we'll see today if that's in case true from the retail sales report. Even as American consumers face the hottest inflation in 40 years. Wall Street has been concerned that the higher prices on everything from food to clothes could eventually stunt the economy into a recession. Investors will get more retail sales data today. Target reports, U.S. consumer reports on retail sales. That's the report that's coming out in about, that report already came out. Let's see what the number is. I can actually give you the actual number. I love it. Let's see. That's the benefit of doing these during the reports. I get to see what the actual number is. Let's see. Drum roll. We'll come back to it in a second. Let it load for a minute. Maybe they're updating it right now. But let's continue with my global update. But we'll find out where the retail sales are in a minute. The Fed in July raised its benchmark rate by 0.75 of a point for a second straight time. And on Wednesday, we'll get more details on the process behind the decision on the Fed. We'll get to see the minutes today. Now it still looks like it's updating. Let's see if we can get a better update. So again, we will see. And the Fed in July, it's raised its benchmark rate by 0.75 of a point. And on Wednesday, we'll get more details. And you can use the CME FedWatch tool. If you want an email for that, just send me an email and I'll send you a link for that. And it'll tell you what's expected. But that's what's on the table. Let's see quickly how futures are behaving and if the numbers are getting worse or better. And it looks like they're staying still. Let's see. Error. We broke the page. Usually it happens when there's a big update, but it doesn't look like the retail sales did anything good to the number. Let's see if there's a headline number here. Let's see. No, nothing yet. Nothing yet. All right, let's continue with our analysis and we'll go from there. So, sectors, something you need to pay attention to. Utilities is now the number one sector, followed by consumer discretionary. And folks, I think consumer discretionary and technology are going to cool off again, and we're going to start seeing upside from the energy sector, from the healthcare sector, and from the consumer staples. On a monthly basis, again, consumer discretionary is still number one. I think this is going to cool off. The fact that we have such fragmentation between consumer discretionary and technology is a red flag right now. And again, I think energy, utilities are going to stay up here. Consumer staples and healthcare will stay up here. I think these sectors will show more upside over the next couple of weeks. Now, let's see if we can get this economic activity. Actual number, here we go. So they were expecting 0.1, they got 0. Not negative, that's okay. X vehicles, they did pretty good. And X vehicles and gas, it did better than expected. So we have some soft landing here. The numbers are not as bad. Again, X vehicles and gas, look at that. That's pretty darn good. I like that. I like that a lot because we know that gas prices are fluctuating And we know vehicles are actually coming off a little bit because the supply chain issue is getting better. So this report is not as bad as I would have expected it to be. It's actually pretty good. Let's see how the market's the market's not buying it. Most of it is priced into the market, I believe. Now, folks, put to call ratio is still bearish. It still has not gone bullish. So we have to be very, very patient, and we have to be very cautious. And again, the biggest giveaway right now, the biggest giveaway that this market is stuck is, if you look at sectors, and I showed you guys this yesterday, you've got 26% versus 97% above the 200-day. That's extremely vulnerable. These sectors with the red are all vulnerable. Communication services, 19% versus 85%, 36% versus 89%. This is foundation. This is greed and fear. Foundationally, we're not that great on consumer discretionary. So you got to be very, 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 very cautious. Now, today is Wednesday, and usually Wednesday I give you my top stock. My top stock now is still Enphase and Paycom. These stocks are starting to really show some upside. And then we've got Monolithic Power and Synopsys. But look, you got Basic Materials. This is widening out pretty good, and I'm liking it. But you still have Occidental. You still have CF Industrial. You still have a lot of boring stocks here. So don't throw the baby out with the bathwater. And again, let's see how the market absorbs all of this data. In terms of the bond market, let's see how the bond market's reacting. The bond market is reactive negatively. So the bond market can handle this, and most of this was already priced in. Now, folks, before I let you go, I just exposed what could be the biggest financial opportunity that I've seen in a long time in any market, any asset, any sector, anywhere. It's a low-hanging fruit. And based on what I'm seeing, it's shown the potential to outperform the S&P by 11 times over 5 years. That's right. And it's all possible thanks to a rare event that's only played out 4 times during the past century. Now, I've made some pretty big predictions during my last 28 years in the markets, but nothing, and I mean nothing, so far compares to what I'm seeing now. Get all the details by clicking the link below. And if you're watching on YouTube, make sure to leave a comment. I want to hear from you as well. Follow the link. It's below this. It's in the descriptor if you're watching on YouTube. Send me comments, love letters, feedback. I want to hear from you. I'll talk to you guys later. Have a fantastic hump day. Bye, guys. I'll see you later.